Good morning, everyone. Welcome to the TradeStation Masterclass. We've created this special series to dive deeper into Futures Plus, which is one of the platforms that TradeStation provides. We're going to explain, what is this platform used for? What are its limitations, and what you can do on the TradeStation desktop versus what you can do on Futures Plus. So this is a 6-part series. So I want you to look out for the upcoming lessons that are going to be a follow-up to this one. This is considered lesson 1, and we're going to concentrate on futures spreads. So just a little bit about Futures Plus and why it exists. On the TradeStation platform, on the desktop, you can trade any futures or electronic futures that is available on any market. But when it comes to trading futures spreads or futures options, those are not traded on the desktop. You would have to access a Futures Plus to trade those. So it's important that we make that distinction right here at the beginning so that there's no confusion about the platform that you're trading and how to access some of the products that we're going to talk about today. So just if you haven't done so already, if you haven't opened up an account that links to Futures Plus, just save that thought in your mind until after the webinar, and maybe you can reach out to our account representatives and they can help you set up an account for Futures Plus. But just to recap and emphasize the point here, Futures Plus is a platform that TradeStation provides in order for you to trade future spreads and futures options. Today's lesson is focused on future spreads, and we have our guest speaker today, Wendell. Brandon, thank you for joining us today. He's going to tell us, the intricacies of future spreads and why is it that you can find opportunities in trading future spreads. And of course, we're going to highlight the Futures Plus platform. I'm going to be here in the session as well, just in case you have any questions about the account opening process. So make sure that if you have any doubts or if you need clarification on any of the processes, just let us know here in the chat, and we'll be, glancing at it once in a while to make sure that we address your concerns. So let's go through some of the disclosures before we get started here. Just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Trading is risky, and we all need to be aware of the risks. And if anybody needs additional information on these disclosures, just go to www.tradestation.com/important-information. All right, that's it for the introductions. Brandon, I hope you're doing well and ready for this presentation, and the floor is all yours.
All right. Well, thank you very much, and welcome everyone. Yeah, I just responded to one of the questions. Actually, I did to hosted panelists. My apologies, but actually the question was, how is Futures Plus different than Option Station Pro? Well, Option Station Pro gives you access to options on equities, options on indexes, options on ETFs. However, Futures Plus, first of all, it's web-based, not software platform-based like you have with Options Pro. OS Pro, excuse me, but also it gives you access to futures spreads and to futures options on futures. So I'll show you that as well. Just quick background for me. I'm not going to spend too much time on me because this is about you and about the markets. I'm a chartered market technician, or CMT, and that basically means that I've got kind of a master's degree in technical analysis, and I learned a lot about different types of charting, things like that. I've been a former hedge fund manager. I was a trader for a brokerage for a little while. So I did the back office operations, market making type activities. And I've been trading actively since 1997, 98, something like that. But I've been teaching trading and investing since 1999. So that's my background a little bit. If you have any questions, let me know. As I dive into, like I said, futures spreads is what we're going to be talking about. And I will be going out, as I mentioned, to TradeStation Futures Plus. So basically, if you go into TradeStation, you were to click on sign in, it'll ask you, okay, where do you want to go? And you can go to your client center, web trading, which many people do, web trading simulator to practice. But right here, you'll see Futures Plus, and it says start trading futures options. Well, it's not just futures options, but it's also what we call spreads on futures. So that's what we're going to be talking about today. And I want to kind of make sure that you understand that when we deal with the futures spreads, we are not dealing with options whatsoever. Okay, it's not going to be options at all. It is simply futures, trading futures, period. So I'm going to change my workspace a little bit. And actually, I don't know where my other workspace is, but that's fine. I can deal with and create a new one with us anyway. But this is Futures Plus. So it is a different looking platform. And actually, let me see. Hold on. If I go to File, Open. Ah, there we go. My other workspace. See if that works. Discard changes. And as you can see, it's very similar to TradeStation's platform where you can save workspaces and actually have multiple different workspaces available to you and different pages at a time. So I can click between them. I just had to upload this one real quick. So it just takes a few moments because, again, it is web-based and everything is housed not necessarily on your computer. It's actually housed at the server, which is possibly better because if something happens to your computer, you can still recover your workspaces. And if I go to a different computer and log in for access, I have the secondary authorization. So I need to not only have my login on the computer, but I need the secondary through the phone code to log in. So it's protected, but I can get the same workspaces wherever I go, which is kind of cool. So yeah, anyway, this is the workspace that I created a while back. It's just simple workspace on Futures Plus. So let's talk about, what are future spreads? And as I said, it has nothing to do with options. We're not dealing with options today. We're just looking at futures and what are the different types of spreads and what are they? And we'll talk about that. We'll talk about quotes, how you understand the quotes, how we do charting on these things because they are a little bit different. We'll talk about margins. You need to know these things. What is the amount of money you need in order to be able to trade future spreads? And what are the risks? Obviously, we need to know, what's the worst thing that can happen and how they're traded. So we can use them in a couple different ways. One is a substitute for directional trading. So many people right now, if you think that crude oil is going to go up, you would buy the futures contract. If you think crude oil is going down, you would sell the futures contract. Well, with spreads, we can actually buy and sell, and you'll see how that works. It will reduce the margin costs, which also can reduce a bit of the risk compared to directional trading, but there is still risk. And because you are reducing risk, you will also reduce profit potential. It goes hand in hand. You cannot have more profit without taking on greater risk. Okay, they go hand in hand. So we'll talk a little bit about that, and I'll show you a little bit about TradeStation Futures Plus. There are going to be more upcoming webinars, masterclass sessions that I'll be invited back for, hopefully, working with Jesus, and we're going to go into more details on how to trade this. So today we're going to go into some of the basics. What the heck is a future spread, and how is it traded? How do we read it? How do we understand anything about it? Later, we'll go into the actual techniques, talk about seasonality or directional trading or contango, backwardation, all the good stuff. So a futures spread is actually something relatively simple. Really is. A spread is when you buy a contract and at the same time sell a related one. Well, if you think of a vertical spread in options, it's the same thing, right? If you want to do a straddle, you buy a call, buy a put. Well, if we want to do a future spread, we're going to buy crude oil and sell crude oil. But wait a minute, you can't buy and sell the same security. It would just cancel each other out, wouldn't it? Normally, yes. We're not doing the exact same contract. We're going to make a slight change. We will buy one contract. Let's say we buy the November contract and we'll sell the March contract. So we're doing related, same underlying security, but different months. And we'll see why we want to do this. So it can usually be done as a single transaction, depending on the broker. Typically with TradeStation and TradeStation Futures Plus, you can place the order all at once, which is better typically because you can get your pricing a little bit faster or better possibly. Again, there's no guarantees. There could be slippage, obviously, but legging in is possible as well, where you do one at a time. However, as one transaction, there may be differences depending on costs. And it's just simple if you can put it in all at once and get out all at once rather than trying to leg in. But as I said, there are going to be times and situations where you do have to leg in, meaning you do the entry of one contract and then follow up with the next contract. But if you do this on TradeStation Futures Plus as one transaction, it gets recognized as a spread trade, and the benefit will be there based on the margins. We'll talk a little bit more about that coming up, okay? By the way, if you have any questions, by the way, we'll do a Q&A at the end of this session, but we'll also, you can type them in, because I know me, I'll forget if I don't ask right away. So I'll go back. If I may not answer them right away, I will get back to them at the end of the session. Okay. Anyway, we're doing this to take advantage of the relationship between two securities. And that relationship changes. Even if they're the exact same underlying, but with different months, they may move slightly different. So for instance, here I have December corn on a futures contract. All right, ZCZ 2024. And then I have March 2025 corn. Well, you notice they're both corn. It's the same thing, right? Well, not really. The months are different. The December contract obviously expires in December. March has a few extra months of trading, and you're looking into the future with your futures contract. And that's why they have them. You'll notice that corn, December in blue, seemed to move down further and faster than the March corn did, especially earlier in the year. Now they're almost identical, but earlier they were definitely separating, weren't they? That's what a spread is. The spread is that white space between those two. So basically, when we're trying to trade a spread, it is the physical distance between the price of one security and another. And you can trade that. That's kind of cool. So when you think about it, you're going, if I were trading corn going back here, I'd be going long corn and short corn. And that means that if corn just collapses in price, it doesn't matter, because we are what we call directionally neutral or delta neutral. What matters is how fast those move. Do they widen or do they narrow? You can use a futures account that you have already funded to trade with Futures Plus, I believe. Okay, but check with the trading desk. I don't work for TradeStation. Okay, I'm just here as a invited guest. But I do believe that you do not need to have a separate account. You do need to have a separate login, though, for the futures. Well, actually, no, I take it back. It's my same login. You have to be authorized for Futures Plus. So make sure you do that. Contact the TradeStation and say, I'd like to trade Futures Plus or use Futures Plus for spreads and options. And we're going to be talking about options as well. Options on futures, just not today. So anyway, the spread is the price difference between the two. So for instance, it could be the same security, crude oil versus crude oil, but with different months of expiration. Or they could be on related securities. They have to be related to be a spread. Okay, you can't just trade the S&P 500 versus copper. I mean, there may be a relationship there, but it's not a high correlation that's going to be recognized. But gold versus silver, two precious metals, or crude oil versus gasoline, you got the raw product versus the refined product. Yeah, you could do those. So basically, let's say one security is trading at 54.35 and the second is trading at 53.17. Okay, the separation between those two is $1.18. That's the spread. It's the difference between price number one minus price number two, or vice versa. It doesn't matter. Okay, you can have negative numbers for spreads as well. That's fine. And basically, the first security moved up. Let's say it went from 54.35 up to 55.16. The second security also moved up, but the spread widened because it didn't move up as fast. You can see the difference between those two now is $1.31. So we call that the spread widening, because what happened is kind of like right here, the blue moved up, the purple moved up, but not as fast. So that spread went from $1.18 to $1.31 and widened. And we can profit from that. Okay. The margin and buying power is going to be different. We're going to cover that. Don't worry. So that's called the widening of the spread. If the difference in price between two securities goes further and further apart, we say the spread is widening. So again, another example, if we had 21.46 for the first security and 21.22 for the second security, you had 24 points between the two. If price number one moves up to 21.61 and the second one also moved up, but didn't move as fast, now we've got a wider spread and it's 31 between the two. So we can trade the difference. In that case, it would have been a profit of 7 points for whatever that security is worth. Now we have also the narrowing of the spread. Sometimes the spreads are too far apart. A lot of times you'll see that gold will move and silver won't, or silver might move and gold won't. Well, they are highly correlated securities. They normally move very close to each other. You can even chart that in TradeStation. There is a correlation tool as a study that you can put in. And I mean, you can chart this on regular TradeStation, I believe. I'm actually using a third-party software that you can integrate with TradeStation. However, to place orders, you actually have to use the TradeStation Futures Plus, okay? Because I can't link my Futures Plus account, I don't believe, to TradingView. So if price number one is 143, price number two is 118, now we have a 25-point spread. And if both move, you see that we went from 143 to 148. So we moved up by 5 points on number one. But security number two moved from 118 to 129. You can see that that second security moved up faster. So the spread went from 25 down to 19. And there's a 6-point spread difference and narrowed. Okay. So basically, this is what it will look like on a chart. Security number one versus security number two. If the prices are getting further from each other, that's widening. If they're getting closer to each other, that's narrowing. That's it. Pretty simple. Now, we're going to talk about a couple different types of spreads. I actually mentioned one already. An intra-market spread is when you buy a futures contract and sell a futures contract on the exact same underlying security. So for instance, you buy gold and sell gold, but use different months. That's the big difference. So you could have, I had an example here of crude oil, December 2024 versus crude oil, January 2025, okay? Or NASDAQ, December 24 versus NASDAQ, March 2025. This is the same underlying, just different months. And you saw that the months can move differently depending on the volume, the direction, the market forces themselves. There's actually two types of intra-market spreads. Intra meaning same, intra, same security. We have what are called bull spreads and bear spreads. So you can trade bull spreads or bear spreads as intra-market spreads. So a bull spread is dealing with the front month. Whatever you're doing with the front month, that determines whether you're doing a bull or bear spread. So if you think prices are going to go up in a security, you would go ahead and buy the front month while simultaneously selling the back month. And the theory behind this and why it should work, again, it won't always work, okay? But it typically will move further and faster in the trend direction with the front month, that is, versus back month. Why? More volume, more trading activity. Again, it doesn't always work this way, but typically the front month should move further and faster with the trend, in this case, upward trend, because it has a heavier volume and more trading going on. So you could use a bull spread instead of buying the underlying contract. I mentioned before, if you were bullish on silver, you can go out and buy the silver contract right now. But you could also buy the silver contract and sell a different silver contract to create a bull spread. And that way you lower your margin requirements and you lower your potential risk and rewards. So the other one, obviously, is a bear spread where you're going to buy the back month and at the same time sell the front month. Okay. Now, be careful depending on where you trade spreads, because brokerages treat these a little differently. In the exchange, they always wanted to see whichever contract you are buying being listed first. So if you're doing a bull spread, that's easy. The front month goes first. But for a bear spread, you're actually selling the front month, so you put that second. Now, it's not necessarily required when it comes to your platforms. So if I go back to my platform here and I bring in, let's see, I think I have this set up for options right now, but as I mentioned, let me just go back to that other workspace, actually. I think that'll work. Oh, no, I got to create a new one. That's fine. So I go to widgets and let me see, market views. I just had the spread matrix. There it is. And I can search for a product. I'll just put in NQ. We'll make it easy. And there's the NASDAQ futures, and I can put in NASDAQ futures spreads and add the tab. I'll enlarge that. And now you can see a grid of the spreads. So I can trade, obviously December versus December doesn't work. But if I do December versus March right there, I can either buy the spread with the blue or sell the spread with the red. So let's just buy the spread. I'll click on that, and there it is, buy, and it's showing, let me zoom in a little bit here, December 24, March 25 calendar spread. I could look to buy that. I could do limit, market, all kinds of good stuff. And that once I'm in the trade, I could also, actually, let me do one more thing here. I just realized, change environment, simulation. There we go. All right. The position is in the futures contract. Yes, you need to make sure you keep an eye out for rolls as well. So if you roll, you got to make sure you do the right months for all that as well. So real quick, I just wanted to be able to put in the positions right now and just play around without doing analysis. I'm not going to do that in a live account. I'm going to do that in a simulated account, make it easier. Anyway, while we're waiting on that, kind of showed you, you can actually put in this case, I did a bull spread where I was buying the front month, but I wanted to show you if you do the bear spread, you don't necessarily have to put in the front month first and put it as a sell. We'll just see what the platform does. And it's still loading up a little bit here. Okay. So anyway, bear spread is just the opposite. You're selling the front month, buying the back month. Why? More liquidity in that front month. If the bearish trend is taking effect on all those securities, it should move down faster than the back month does. And again, you can either sell a front month, or you can go ahead and do that spread to reduce margin costs and potentially reduce risks. So again, let me see, did this load yet? Wow, it's taking a little while this morning. Might not have had all its coffee, I guess. It'll load up in a moment. That's fine. So the other type of spread, I mentioned we have intra-market, but we also have what are called inter-market spreads, where you can trade two related securities. So the underlying is going to be different. The months can also be a bit different as well. Okay. So you can buy a contract and sell a contract on a different but related securities. Perhaps you do soybeans and soy oil, okay, or soybeans and soy meal. We call those the soy crush, because you're crushing to get the raw product into the oil or meal. But they can be separate but related securities, and they don't have to be the same month. You can actually do different months as well. And that's kind of what I just mentioned right there. Now, the two contracts could have the same expiration. They do not have to. So let's see. Oh, there we go. Load it up, and I'll do future spread trader for the workspace. And I think it just froze. It's loading up that workspace. I shouldn't have done that. That's okay. So a couple examples I mentioned, we can do crude oil versus heating oil, and I have the same month there. But it doesn't have to be the same month. Or NASDAQ versus Russell 2000, or Euro versus British Pound. Those are intermarket spreads, okay? So when it comes to intermarket spreads, the intramarkets are a little bit easier in a way because they're the same underlying security, right? Corn versus corn, or coffee versus coffee. So they have the same tick value and same point values. However, when you go to intermarket futures, they have different values. If you're not aware of those values, you could actually find them on TradeStation. One of the easiest things to do, if you go to pricing and futures margin rates, I believe that's where it is. No, it's not there anymore. I thought they used to have the point values listed there with the tick values, but it's not there right now, but that's okay. Anyway, there's plenty of places to find them, but just, think of it. If you look at gold versus silver as an example, gold has a point value of $100. Each tick is 0.1, and each tick is worth $10, right? But silver, you're trading 5,000 ounces, and it trades in 0.005. So completely different. Its point value is $5,000. So you can't just do one against the other because you're comparing apples to oranges. We need to make them comparable and tradable. So we have to adjust for values and volatility. Some securities are more volatile than others, so we make sure we adjust for that. Whenever you look at a chart, for instance, I go back here, and that's taking longer than expected. Okay. So for instance, if I look at lean hogs. So here's my lean hog chart. And what we're seeing on this chart right now is market value. Okay, that contract is 74,800 right now. But that's not the actual value of the contract. If you were to go ahead and exercise that contract, you're trading something worth much, much more in value. So the market values are what you see on charts. There's another value, which is the actual value of the security that's covered by the contract. That's called notional value. As an example, if we take well, actually, hold on, one more step. Notional value, we use it for hedging and for intermarket spread trading. And it's very simple. Notional value is the market value multiplied by the point value. That's all. So if we wanted to know for lean hogs, what is the notional value currently? I'm going to use a calculator. And all I have to do is, okay, point value is $400 per point for lean hogs. And if you don't know, you can look it up. There's places to do that. And let's multiply it by, say, 74.825. And one contract has a notional value or basically covers $29,930 worth of lean hogs. That's the actual value of that contract. That's all. And if you were to take a look at something like crude oil, crude oil has a market value of 71.10, but you're trading 1,000 barrels of oil. So 71.10 times 1,000 is $71,000 worth of crude oil. That's what the contract covers. That's the notional value for that particular security. And that's what we're going to be using. So when it comes to intermarket spreads, we use the notional value, which is nothing more than the market value you see on the chart multiplied by the point values. Now, the market value obviously changes, right? You take a look at a NASDAQ contract right now, and that's 19,881. It's a little bit cheaper than it was a couple of months ago. Not too much, but a little bit. It's actually cheaper than it was earlier today. So what is the value of one NASDAQ contract? Well, again, 19,876, although it keeps changing, times $20 a point. You're trading almost $400,000 worth of securities when you trade one NASDAQ full-size contract. The micro obviously has a smaller value. So that's notional value. Very simple. Multiply whatever you see the price on the chart times the point value of the contract. Now, why do we do that? Because when we're charting, we actually want to chart notional values, especially in intermarket spreads. It makes it easier to understand the potential risk and the potential rewards. So you can see that, well, maybe you can't. I'll zoom in again. On my chart, I created a chart of the NASDAQ versus the S&P. However, you'll see I put the quote NQZ 2024 times 20. That'll automatically chart the notional value minus ESZ 2024 times 50. So I'm charting the notional value minus the notional value. Notional value of NASDAQ minus notional value of ES. And that's what you see on the chart when you chart spreads. You literally, whoops, zoom back out. You literally just chart one price minus the other. And if you need to, you adjust for the notional values. So again, if I go out to the current chart here, I have the NASDAQ showing. And if I want to see how's that NASDAQ versus another NASDAQ contract, intra-market, I just do, let's see, we've got December. So I'll do NQH 2025. Oh, did I forget to put the symbol in between? I did, the negative. And there we are. Now that looks a little funky, doesn't it? A lot of times when you're looking at intramarket spreads, it may be a little bit more beneficial to use a line chart on close like that. Or, again, different securities chart a little bit differently. We'll talk more about that in the advanced class when we get there, okay? Now, if I want to do NASDAQ versus S&P, as I mentioned before, you could just try to chart it NQZ versus ESZ 2024. The problem is you're not comparing the exact things. You're comparing something worth $20 a point versus $50 a point. Now, the movement in the chart might look similar, but we need to do notional values. That's still showing the notional value, market value. You're basically taking the $19,000 NASDAQ minus the $5,600 S&P. So if we correct this by adding in the point values, multiplying by point values. Yeah. Oh, sorry. There's some noises behind me. It's my dogs. And there it is. That is the notional values. It changed a little bit. The shape overall is about the same, but the details are a little different. And you got to be careful there. So now our notional value is 110,000. And there's a really good reason why we do this, other than just comparing apples to apples now, rather than apples to oranges. The other thing is it's much easier to figure out profits and losses. So again, NASDAQ, 20 bucks a point, S&P, depending on, I did the quotes a couple days ago, and you can see we chart it as one minus the other, but we put in that multiplication for the notional value. So we're getting the correct charting there. Now, another thing we have to be aware of is that not all futures move the same way. There are different varied volatilities and activities on different securities. Some are a little bit quieter, some are a little bit more violent. So when we look at doing spreads, I mentioned this before, we're trying to trade the physical difference between two securities, which means we don't want to have directional exposure. If both securities go up or both securities go down at the same rate, if you're delta neutral, you do not gain nor lose any money. Okay, there might be a little bit because it's almost impossible to be exact, but for the most part, we're trying to profit or lose from the difference between the two, not them both moving up or down. So to remove that directional, we want to go delta neutral. That may require us to hold more than one contract on one side of the equation versus the other. Sometimes you'll get things like 6 to 5. Okay. So basically, you'll have to make adjustments for notional values, but you may have to make adjustments for volatility for the delta as well. And it does reduce that effect of directional risk. Now, you don't make it up and there's no calculation you have to do. You just simply look it up. So the CME Group margins webpage will actually show you the correct ratio to use. It's pretty simple. Okay. You go to the CME Group. You can actually go to any security on their webpage and you go to the margins page once you bring up, crude oil is the example I used. Literally, you just go out and I'll show you how easy it can be. Just go out to cmegroup.com and it'll come up markets. And instead of crude, let's see, if I click on markets, let's do soybeans. Again, it doesn't matter which one I choose. The main thing is I'm going to go to the page that says margins right there. By clicking on that, now I get to this page where I have a choice. Outrights, those are your directional trades. If you want to buy or sell soybean contracts right now, it shows you the maintenance margin. Now be careful, that is not the initial margin. And by the way, I did show you on TradeStation right here, futures margin rates. And you have intraday and overnight long and or short. And it's the same ones you would see by going to that web page. But we're going to do something different with this. So these are the outrights. Keep in mind, maintenance is not the same as initial margin. To find the initial margin, you multiply whatever's shown on the maintenance by 1.1. So as an example, you could do this in your head, I guess, but 2,200 for soybeans times 1.1, the initial margin is 24.20. So if I go back over to TradeStation and the futures spreads, and I go to agriculture, soybeans, there we are. Look what it says. Overnight margin 24.20. That's it. So basically the initial margin, or sorry, the maintenance margin is related to the initial margin, but the initial margin is 110% of the maintenance margin. That's all. But anyway, that's the outright. We're not going to worry about that right now. If I'm going to trade soybeans versus soybeans, I click on intras and notice, that this is now going to show me 1-to-1 ratio for the most part for the delta because I'm trading soybean versus soybean. Keep in mind, you got to find the right months. I'll zoom in here again so we can see the text a little better. So you got start period, end period. If I'm going to trade the November or December contract versus January or February, then this would be the one I'd use, this margin. And again, that's the maintenance margin. We multiply that, and we actually have an initial margin of $1,100. for a spread. That's where you buy one, sell one. You'll see it says ratio and side. A can be a buy or a sell, long or short. B is just the opposite. That's all. So if we're doing, you'll notice some of these are a little different. This one is a soybean spread, and it's a ratio of 1:1 ABA. Anybody know what that one might be? It's very similar to something you would see when it comes to trading options. We have an ABA setup versus just 1:1. Does anybody know what kind of strategy? Anybody still awake out there? Just checking. It is a butterfly. That's a butterfly strategy. And yes, you can do, these are vertical spreads basically, or well, not really vertical. Sorry, these are calendar spreads because you're doing different months, same security. That's a butterfly. So anyway, my point is that the A versus B, no big deal there. We're doing intramarket spreads. We can change to a different security. If I want to go CME, equity index, I can look for things like, where's the ES? There it is, E-mini S&P. And again, 1:1 ratio because you're trading intra-market, December versus March. That's an intra-market spread. How much is the maintenance margin? $150. Wow, right? So if I want to do an intra-market spread, again, you multiply 1.1, it's $165 for the overnight margin to do a spread on the ES. How much would it cost to hold one contract on the ES overnight? Just a regular regular directional trade. Well, we look for the ES, and there it is, $16,060. A little bit of a difference there, isn't it? The margin for the directional trade to either go long or short the ES overnight is $16,000. The margin for a spread is only $165. Well, that tells you that the spreads have much lower margin requirements. Therefore, there's going to be a lot lower risk in comparison to directional trades, but there's still risk. Okay. And of course, you're not going to make as much either. Margin is kind of a relationship or has a relationship with risk. The higher the margins, the more risk there typically is in that security. So going back, nope, I want to stay on that page one more time. The next one you'll see is intermarket. So the intras are, again, the same security against itself. Intermarket are related securities. So I mentioned this one before, soybeans versus soy meal. And again, it's a 1:1 ratio. But trading soybeans versus soy oil, now you'll see that has a 2:1 ratio. You have to trade 2 oil futures, ZL or soy oil, okay, the BO, depending on which platform you're trading with, versus 1 soybean contract. Okay, so you got to make sure, and it says right there, delta ratio. One is going to be a long, the other one would be a short. So this one would be a short, this would be a long. But you have to maintain that ratio for each spread. If I wanted to trade 3 spreads of this, I would do 3 to 6. That's all, just multiply by the number of contracts. So keep in mind that intermarket spreads get a little trickier. You need to know the point values to make the notional values for the chart, and you need to know the delta ratio to have a delta neutral position as well. So the way I got there, again, I just went to the CME Group website, go to margins on any security. Now you can go on Inter right there. There's also Intex and Supers. Don't worry about that. And then pick whatever it is you want, the right exchange, the security you're looking for, or the asset class and security, and it'll list those. Make sure you check the dates and the proper ratio you need to use. So here I'm on crude oil versus Brent. Again, if I'm trading November, it's this contract and these margins. If I'm trading different months, like August of next year, the margins are different. April and June. That's Brent versus West Texas Intermediate crude oil. So keep in mind, you got to find the right security that you're trading to know what the right ratios are and the right margins. So here, looking at the Russell 2000 versus NASDAQ, we actually have to do a ratio of 3:1 in this case. So there's a big difference in delta there. British pound versus euro. Well, the British pound is $62,500 per point, while the euro is 125,000. The correct delta ratio based on the volatility and point values is 5-3. So for every spread, you would trade 5 pounds versus 3 euros. That's how you do a spread. Now, some of them may be a little bit more complex. You can see this is a more complex one where you need 4 live cattle, 2 feeder cattle, 1 corn futures. Okay, so you mix them up. There's different spreads out there. But keep it simple to start with, obviously. Now, with charting the spreads, I mentioned before, the way we chart these is just simply one minus the other. You don't want to do it like this where you have corn and then you throw the other corn contract on top of it, or even have to flip back between the two. Instead, you do the chart one minus the other. So here we had March, $435, or $4.35, actually, minus December, $4.18. That spread was 17 cents wide, and that's what gets charted. The physical difference between the two charts, the white space between the two, gets charted, whatever that value might be. That's how you chart spreads. So intra-market, again, you can put either contract first, but what you have to remember whenever you are charting spreads, the contract you place first is the one you are actually charting. So in this case, I happen to have crude oil November versus December. So when this chart is moving up in price, that's telling me that November is getting more valuable than December. If that chart's moving down, then the November is getting weaker than December. So just kind of pointing this one out real quick, I'll show you the difference. If I do CLX 2024 minus CLZ 2024, that's the spread we just talked about, right? And that's it. I could do it as a candle chart. I could do it as a line chart. It really doesn't make a difference. Or if I wanted to reverse this, CLZ X. It just goes the opposite direction. And I can buy that or I can sell that. It doesn't matter. Whatever you want to do. And before I go back, let's see. Did it switch over? Yeah, it did. So again, if I go to my spreads, I'm not sure why it didn't populate. Come on. Let's go to my next tab. There we go. Cancel orders. Oh, here we go. Come on. It's loading it up right now for the spreads, hopefully. That's really weird. I'll just add a new tab, make it easier. Again, I can go into, let's say, corn, ZC. There we go, corn futures, spreads. Add tab. And it is loading. You gotta be a little patient. Program runs pretty decent, but it does slow down a little bit every now and then. And also, I'm having some issues with the internet today, so it's not just the program, it's me. But we'll come back to that. Or did it just pop? Nope. Anyway, so basically, when you're doing an intra-market spread, if you're charting the market values, you have to multiply by the point value to know how much you're going to gain or lose. And that's what I was saying. Sometimes you may actually, even on intra-market, you may want to chart the notional value instead. Because right here, we saw that, okay, if I was going to sell at this supply zone and put my stop loss, I'm selling at 92, buying it at 1, that is 8 cents of risk times $1,000 a point. That's $80 of risk. And my target was 60 cents away for $600. However, intermarket spreads, if we chart the notional values that I showed you earlier, so again, silver times 5,000 minus gold times 100, now what you see on the chart is what you get when it comes to profit or loss. So we chart the notional values, number one, just like that, and it's showing 1-to-1. Or if you need multiple contracts for the delta, you make sure you add that in. Notice it says 3 times Russell times 50, the point value, minus 1 NASDAQ times 20, the point value. So when it comes to intermarket spreads, make sure you do the right number of contracts and you chart the notional value. And here's why. In this case, I'm charting the notional values. And that means if I had that risk between 17,981 and 18,357 and a half, it's much easier to calculate that as my risk, right? 18,357.4, 17,981, the difference is 376 and a half. I just have to convert that to decimals. Okay, apostrophe 4, that's a half. Apostrophe 2 would be a quarter, and the apostrophe 6 would be 3/4. Now for this reward, same thing. I'm in negative numbers, so we take 20,825 and a half, 18,357 and a half, and I have a reward of $2,468. Much easier to deal with, isn't it? And like I said, you could do that with intra-market spreads as well. So if I go to my chart once more, I'll do candles, and let's do 60-minute chart. Let's take a look for fun. Let's say I was looking to sell this area right here. Okay, we have 42 and 37, right? So we have 5 cents between those two. Well, 5 cents times 1,000, that tells me that's $50 worth of risk. And I can do the same thing calculations for my targets. But if I was doing crude oil versus heating oil, I just do CLZ, I'll do the X contracts, that's the current month. It's 1 crude oil times 1,000 for the notional value minus HOX 2024 times 42,000. That's the point value. And there we have our chart. Now, if I was selling, let's say I'm selling the contract of spread at this supply zone, now all I have to do is subtract those two. The difference is going to be the risk. That's it. So we have 21,755.4 minus 21,486. That's $269.40 of risk. That's it. Notional value. Could I have done notional value for my charting of the intramarket? Yes, absolutely. We were using CLZ 2024 times 1,000. Minus CLX 2024 times 1,000. And remember, I was using this little area right here. Difference between the two, 370 to 420, well, $50. It's the same. So you can chart notional values intra and intermarket, or if you want to, you just use the market values when you're doing intra-market spreads. Intra. Okay. And what is going on here? Why am I not seeing this data now? It's weird. I'll figure it out later. So that's it. Charting the spreads, you're simply charting one versus the other and the price difference between those. And you have to make sure you're delta weighted properly. And you can use notional values when you're doing intermarket spreads to get the actual values on your chart. So same thing here. Our risk, in this case, I was going long at demand, $540 of risk, buying at 15,140, getting out with my stop loss if I was wrong at 14,600. The price difference is what you make or lose. Now, could I lose more than that? Yes. Okay, keep that in mind. Remember, when you put in a stop loss, there can be slippage. So be careful. That's not exactly what it's going to be. Now, for the margins, to figure out what the margins actually are, it's pretty much the same place I just showed you on the CME website. What you'll notice, though, when you find a pair that you'd like to trade, and I'll go to the CME Group website again, on the intra markets, I already mentioned, they show you the maintenance value. You multiply that by 1.1, that's the actual value of the initial margin you'll need. But on intermarket spreads, notice it says credit. Okay, doesn't matter which one of these intramarket spreads you look to trade, they'll say credit, and it can be as high as 90% credit. In this case, it's 75% credit. What does that mean? Well, it means you're getting 75% credit for whatever that margin would be normally. So we're doing soybeans versus soy meal. All right. So let's figure out if we want to trade that spread, what would be our margin? Well, the margin rate for soybeans, and I go back to the TradeStation website here. And let's see, I'm going to bring up soybeans. I think it was what, 2,400 something? Yeah. Initial margin 2,420. And that's soybeans. And we're doing versus soy oil, I said. Oh, no, sorry, soy meal, BO. So soy oil has an overnight long margin of 1760. Okay, now we got it. So 1760 plus the 2,420 is $4,180 for margin. That's what you would normally need. But remember, we're getting credit for 75% of that, which means we only have to have 25% for the margin. So to carry that overnight, that one spread, soybean futures versus soy meal. Now, this is for each one spread. If you want to do 5 spreads, you do 5 of those. But right now, for one spread going long soybeans, short soy meal, or the other way around, it's 1,045 for the initial margin. That's it. That's how it works. You get credit towards. Now, you have to put the trade in as a spread. You have to put the order in at once. If you leg into it, it will not give you that margin until the end of the day. The back office will recognize the margin spread. The spreads are being placed if there are related securities, and they'll reduce the margin cost then. But if you do leg in, or you create your own spread, say, even the NASDAQ versus the ES may or may not get recognized depending on the brokerage. Sometimes when you try to place that trade as a spread, it puts them in individually. Why the heck is my matrix not working here? Not sure what's happening here. That working. Oh, there we go. Now, finally. All right. So ES, there we are, intra-market. And by the way, if I want to do the sell, remember that if I do the bull spread, I'm buying the front month and selling the back month. And that's not the spread, is it? Wait. Calendar, there it is. I was looking at the wrong one. This is the calendar spread. Should be. Nope, that's the outright again. There it is, calendar spread, December versus March. Yeah, in this case, it's showing the front month first. It's still downloading the order book. That's why it hasn't done everything correctly yet. But I can actually click on buy or sell, even though I had the front month first. And I think that on the TradeStation Futures Plus, it typically puts the front month first, whether you're going long or short for the position. It doesn't matter. So I'll come back to that once it's finished loading. And basically, whatever the margin, or sorry, whatever the credit is being shown here, that's how much credit you get towards the margin, the initial margin. You need to come up with the balance of that. So for here on feeder cattle, live cattle shows 65%. You would need to figure out what is 35% of the margin for each one of those contracts, initial margin. That would be your margin that you need for the spread. That's it. So as an example, I had that feeder cattle versus live cattle. Now, again, going back one page, you'll see it's a 3-to-2 ratio. 3 live cattle for every 2 feeder. That's one spread only. So in order to figure out what the margins would be, I go to the margin rates, again, using the TradeStation margin page for futures. 3 live cattle, well, it's $26.95 times 3 is $8,085. 2 feeder cattle at $4,500 each, $9,000. Total is $17,161, but because we get that 65% credit, 35% of 17,000 is 6,000. That's the initial margin. Done. So a couple of really cool things about spreads. Some of the reasons why you may want to do that. Number one, they work in pretty much almost any market condition. Remember, we're delta neutral. It doesn't matter if the markets themselves go up, down, or sideways. We're dealing with the differences between 2 related securities. The other nice thing is you reduce your risk. Because you're long and short, you're taking the directional risk out of it. If the markets collapse, but you're in an intra-market or intermarket spread, trading the NASDAQ versus the Russell, It's a matter of how fast they move in relationship to each other, not whether or not they go up or down. You're delta neutral. You also have to spend less money with the margins. And because you're long and short, typically drawdowns will be less. Now, there's no guarantees, but again, if you're even in a directional trade, say, for instance, you were long on the NASDAQ right now, and the NASDAQ's been going down today. If you were in a NASDAQ spread, the drawdown, even if you're in a bull spread, will be lower than what you would have if you were in a directional trade. So you've reduced a lot of your risk, but again, at the same time, you're also reducing a lot of rewards. You can, depending on the brokerage, again, you can actually do future spread trading in retirement accounts, depending on the brokerage. So that's kind of nice too. You saw that a $16,000 contract for the margin requirements for the ES got reduced to $165. There's a lot less risk in trading futures spreads than there is in trading futures, but there is always risk. Just because you have a high correlation normally doesn't mean it's always going to be that way. So there could be failures of correlations, commissions, you pay more. Obviously, there's more fees if you're trading more than one contract versus trading just one directional contract. Liquidity could be an issue. If you're dealing with contracts that don't expire for another few months or even next year, you got to be careful because there could be some liquidity issues. It may be more difficult to get in or out of a particular security. And finally, leverage. Be careful when you're using this extra leverage. Your margin requirements are reduced. You're still controlling large size contracts. It is possible to lose more than what your account size is. So you got to be careful with all those issues. So when it comes to trading the future spreads, we talked a little bit about what they are. And again, we're going to review some of this in future courses as well, or future master classes. And we're going to talk about how to actually do this stuff, how to chart them and identify opportunities, things like that. So when it comes to directional trading, instead of doing a regular buying a contract or selling a contract, you can use bull spreads and bear spreads to reduce your directional risk, reduce your risk and margin requirements. A lot of people can't afford to hold certain securities overnight that they might want. Margins are much, much lower when it comes to the spreads versus directional trades. If there's an abnormal relationship between related securities, gold versus silver, corn versus soybeans. That's a popular one. Corn and soybeans grow in very similar conditions, and you'll see them alternate. If you drive through the flyover states, if you will, outside Chicago, you'll see a lot of soybean fields right next to corn fields. Well, there may be relationships that get skewed because there's too much corn or too much soy versus the other. There's also what we call contango and backwardation. Contango is a normal relationship. When you think about it, the further out you go in time, the more expensive a contract should be. For instance, soybeans, if I go to a quote right now, November, highest volume, and it has moved 3 points today, or about a little over 0.25%. It's interesting though, because you can see that the further out contracts have less volume, but they actually changed a bit more. They went up further. However, you can also see the last price 1060, 1078, 1092, 1105. They're getting more expensive the further out you go. That is called contango. I didn't make that up. It really is called contango. You can look it up. Contango is normal. The further out in time you go, there's more time risk. There's more potential price movement in those contracts. So they should cost more. However, if the further out contracts are cheaper, that's called backwardation. So we'll talk a little bit more about that. We get what's called reversion to the mean, and we can trade for that abnormal relationship to go back to normal by using spreads. And there's also commodity product spreads. Again, we'll talk about how to actually do those when we get back together. But it's trading a commodity like crude oil versus the refined product like gasoline. They call those crack spreads. Or I mentioned soybeans, the crush spread, soy versus soy oil. Okay. So you do directional trading when you're expecting a big move in price. Typically, the front month has more volume and moves further and faster in whatever trend your direction is moving. The margin is lower, which is a great advantage over trading directional. The reward is lower as well. I have to keep mentioning that. But you get some protection if prices don't go the way you wanted them to. And actually, I just kind of showed you this crude oil right there. You can see we're in backwardation. Look at that. This is backwardation, by the way. The front month is the most expensive, 68, 64. It goes down to 68.11, 77, and they're getting cheaper. That is an abnormal relationship, and it typically happens in overall bearish moves in the markets. But what I wanted to point out is in this particular day, when I took the picture, it's actually a couple of days ago, you see the heaviest volume is the front month, and that's the one that made the biggest move so far for the day. The further out you go, slower they were. So if you were in a bull spread during this day, you would have made profits by buying one contract and shorting a further out contract. So again, if you're expecting soybeans to rally or drop, in this case, they rallied off these lows in August. You could either go long on soybeans with the $2,420 margin, or you trade the spread for half, less than half. And the spread also moved up. Now, did it move up as much in points? No, it will not. But percentage-wise and rate of return could be pretty good. So intermarket spreads, basically, you can trade them directionally as well. You'll notice here, I was looking to buy in a demand zone. I had some targets near my next supply zones. You can use Bollinger Bands. I don't know if you noticed when I was in my charts, I actually had Bollinger Bands available because I can use that to identify whether prices are at extremes. And when they go to extremes, they often go back, or what we call mean reversion. They have a lot of different spreads I've been watching, feeder cattle, for instance. And you can look for opportunities where you go narrowing of the Bollinger Bands. You see, we came back to the midpoint. Narrowing bands usually leads to an explosive move. And there's the explosive move. And you can place stop losses just as you would in a normal directional trade, the same thing. So there's a lot of different opportunities. And again, we're going to go more into those when we have more time. So speaking of more time, our next session, I think, is going to be on options on futures, which again, we'll be looking at Futures Plus. But eventually we're going to get into another upcoming lesson called Futures Spread Trading Techniques and Tactics, where we'll actually show you how you can get into this as far as identifying opportunities and maybe even taking advantage of those opportunities. So I hope you enjoyed the session. I'm going to turn the microphone back over to Jesus in a moment here. And I want to thank him and you for your time. This has been the Masterclass Lesson 1 for Futures Series Spreads and Options on Trading Future Spreads. So thank you.
That's right. Yes, this is lesson 1. So stay tuned for the next lessons on this series. I think, Brandon, I think we agreed on doing this bi-weekly, right? So let me just check the events calendar here in just a moment. The next Futures Plus session will be October 15th. So exactly, 2 weeks from now. Make sure that you register for that session. These are individual sessions. So the fact that you registered today doesn't mean that you're automatically registered in the series. So make sure that you look at the events calendar, look for that session, October 15th, where we're going to be talking about advanced future spread trading techniques. So this is a follow-up to this same topic, right, Brandon?
Sorry, yes, it is. Yeah. So we're going to go, actually, I thought we were going to options, but no, we're going to expand upon this. So that is going to be the one where we're actually going to talk about how to deploy this and actually look at opportunities.
And if it's options, we may just tweak the title and description if we're going to jump into options. But it's fine. I think for now, I think it's strategies on future spreads. If we can expand, more than that, that'd be perfect. But yeah, the content was great. Thank you, Brandon. I mean, this is just great information, and you have a very good handle on Futures Plus platform. So I appreciate that too. So I guess I just want to say thank you for everyone that took time and attend this webinar, and I look forward to seeing everyone on all our sessions. So make sure that you explore the events calendar and see if you see a topic that catches your interest, and be happy to see you there. Okay, Brandon, thank you again for your time, and everyone have a wonderful day. Thank you for joining today. Bye-bye.